This is Radio Free Wall Street with Lee Adler, on the web at radiofreewallstreet.fm and wallstreetexaminer.com. Hi everybody, this is Radio Free Wall Street, recorded Monday, October 13th, 2013. I'm Lee Adler. Sadly, last week, my mother, Shirley Adler, passed away at the ripe old age of 92. She suffered from Alzheimer's disease for 9 years and died from its complications. Over that 9-year period, I have actively managed all of the aspects of her life, and I've become quite experienced in some of the issues of elder care. If you are in a similar situation and you are facing some critical decisions, if I can help you in any way, I'll make my experience available to you. You can write to me at admin@wallstreetexaminer.com. I'm particularly familiar with the issues that apply in the state of Florida, where I reside, and of course, many of us, our parents do live in Florida. So again, if you're in that situation, you need a little advice, a little help, feel free to call on me. You can send me an email at admin@wallstreetexaminer.com. I'll send you my phone number and we can chat. Having lost both of my parents, now I have a sense of the finiteness of life and looking at the things that I need to get done with even greater urgency than before. So let's get to it. This week, I want to look at a couple of things. One of the things I noticed, and I reported on it today in the Wall Street Examiner Professional Edition Fed report, is the sharp drop-off in withholding tax collections over the last couple of weeks. Now, this tends to happen from time to time. Every 3 or 4 months, we do see a decline in those collections, so there is a cyclical aspect to this. But we're getting to the point now where it's at a critical point, and over the next few days, week, 10 days maybe, we'll find out whether this is just another normal cyclical resting phase or whether it's something more significant that might indicate that the U.S. economy is falling off a cliff. And when we consider what's going on in the stock market at the same time concurrently with this decline in tax collections, we have to wonder whether there might be something serious going on. So today I'm going to take a look at the withholding tax chart and then the long-term chart of the S&P that we review from time to time to get a handle on what the stock market might be doing. So let's go right to those. This is a chart of federal withholding taxes reported daily on the U.S. Treasury's daily Treasury statement, virtually in real time with about a 1-day lag. And this chart is through Thursday, October 9th, 2014, and it shows withholding taxes, the real annual percentage change versus obviously the same date 12 months ago. Now, I apply a couple of smoothing techniques because this is an extremely volatile series, but the first thing I do is I take an 11-day moving average of the real annual percentage change. And I use that because the typical pay period for most employers is either 2 weeks or twice a month. So 11 days is a fairly good smoother for that pay period. And then I run that on a 4-week moving average, which is the red line that you see here. Now, what do I mean by real annual percentage change? Well, I take the nominal percentage change and I subtract an amount for the rate of increase in wages, which has been running at about 2%. The key thing here is that in September, this 4-week moving average at one point reached a 5% rate, very strong rate of growth versus 2013. And that enabled us to take a guess that the non-farm payrolls for September would be stronger than expected, and indeed they were. The trend, however, suggests that the U.S. economy is slowing. Let's just go back to the beginning of this year. Prior to that, we had an effect from a change in the tax rate, but this year that effect is washed out. We don't have to worry about that. And from the beginning of the year, which is right about this point here, we see some fluctuation, and this is fairly normal. We had the same thing last year. Every 2 to 4 months, 4 months, there seems to be a fluctuation. First a rise in tax collections and then a fall. And the trend, as you can see, has been one of steadiness here, but not quite as strong as it was back in the first quarter. So there's been some slowing in the growth rate. What concerns me now, from mid-September until now, or about a month, we've seen a steady reduction in the trend. Now, is this part of the normal fluctuation? It looks very similar to what happened back here in June and July, where there was a similar slowing. And we're down to a level now where the real growth rate is only at about 1.4%. Now, if you believe that the official government statistics on inflation are understated, maybe that growth rate is closer to 1% or a half of 1%. Very, very slow growth on a year-to-year basis. So far, this only looks like a normal fluctuation, such as we saw from January to May. Here we had a slowdown in July, early July, a peak, a couple of peaks, one in September and one in late July, and since then a gradual slowing. So now that we're at a nominal growth rate of around 3% and a real growth rate of around 1 or 1.5%, we're at a very critical juncture. Just applying a little technical analysis here. A break below this level that we saw, say, in early July, which was at about plus 1%, if we go below that, that would suggest a change in trend of the U.S. economy, that it has begun to slow more radically than it had been showing. There's another trend line, if we connect these lows on this moving average here, that's down around 0. So just to be extra certain that this isn't a sea change in the economic growth rate, we can give this a little more room, down to about 0, but only very briefly. If it gets down to that level and hangs around there, that would suggest again that we're in a period of a severe economic slowing. Now, government policymakers tend not to, at least publicly, not to look at these real-time data. They look at lagged economic data, in particular the employment data, which is a month behind the curve, and other data series are even more than a month behind. So assuming that government policymakers are not looking at this real-time data and just not talking about it, they're going to be behind the curve in reacting to any substantive changes that do occur. So we're going to keep track of this week to week. The next week is especially critical. It could begin to rebound here, and if it does, then we've just seen a normal cyclical fluctuation and nothing has really changed. But if over the next 2 or 3 weeks we continue to see this growth rate decline, then something very different is going on. The question is, when will the Fed and policymakers become aware of that? And then what they will do in reaction to it. Will they reverse the slowing of quantitative easing and attempt to goose the economy again through monetary measures? That would be bullish for securities. But if not, if they remain locked on their current course, we could continue to see waves of pressure hitting the stock and bond markets. This is a chart that we return to from time to time to get some perspective on the market, and in particular at times when there's some turmoil such as we have seen in the last week or so, and especially today as we are just about at the closing bell and the S&P is down about 30 points at 1875. And I've drawn in a weekly bar for this week right here, starting out just today, Monday. And as you can see, a couple of important things have happened. We've broken some major trend lines. Now, this is a weekly bar chart, so where we close on Monday doesn't count. It matters where we close on Friday. And the number to watch out for, I think, was 1885, right where I have my cursor right here. That's where the trend line is, and that's what the S&P has to stay above in order to avoid breaking this trend line, and that goes all the way back to the 2009 low, connects with the 2011 low, and right here. So this is only the second time in 5.5 years that we've touched this trend line. And in fact, today, we're a couple of points, maybe 10 points below it. So if we close the week below 1885 this week, we're going to break the long-term trend line from the March 2009 low. That is significant. It may not completely prove that we're in a bear market, but it would certainly lean in that direction. Now, I talk about bear market. The conventional definition of a bear market is a 20% decline, and that's something that has become standard because all the talking heads and morons that appear on CNBC have agreed on it for no reason other than they agree on it. My definition of a bear market is more similar to the Dow theory definition. It's when two key indexes or averages have both made lower lows and lower highs and lower lows. And the 20% standard is meaningless to me because some indexes are more volatile than others. Obviously, the IWM, the Russell 2000, is a lot more volatile than the Dow. So you can have, and this holds true for sectors as well, you can have some sectors in bear markets every other month on the basis of the 20% standard. And other indicators, such as for utilities or other low volatility sectors, some of the tech indicators have very low beta, very low volatility. They will almost never go into a 20% decline. So you would never have a bear market. So I use the old standard definition based on technical analysis. Lower lows, lower highs. The S&P has not made a lower high yet, but it has made a lower low. Now, if over the next month, 3-4 months, we get a rally that does not exceed this high of 2010, 2020 on the S&P, and then we get a lower low, that would be the classic definition of a bear market in my mind. But that's too late. So what do? We look at some of these long-term oscillators. And the long-term momentum indicator, one of the things that I want to see in order to call a bear market is a negative divergence. So here we have a negative divergence over the space of about 18 months from the March 2013 peak here to mid-year in 2014, and then in August, a little bit lower. And now we've broken a trend line going back to the 2011 lows. So that suggests at least the potential for that we're entering a bear market. I would like to see this low broken right here before I'd make an out-and-out call that we're in a bear market. I wouldn't call a secular bear market unless we broke this long-term trend line here that goes back to the 2009 lows, but at least getting into negative territory before what I'd call a secular bear market. Right now, I think we're on the doorstep of a cyclical bear market. It's got a similar situation with two-year cycle momentum. It has been trending down as the market has trended higher. That kind of negative divergence typically precedes a bear market, but here again, we have a critical low that hasn't been broken yet. I'd want to see this low, this line broken here before I'd make the call that we're in a bear market. Now, we've broken the long-term trend in the three-year cycle momentum that goes back to the 2009 low. We've broken that trend. But again, here, I'd like to see a break of this low in 2013 before I'd feel certain that we're in a bear market and we're going to see intermediate swings falling short on the upside and making new lows on the downside. Note that the cycle oscillator has begun to edge down, but it did the same thing in 2011, and all we got was a little correction here. So this in itself is merely an indication that the cycle is entering a down phase, but because the long-term trend is still skewed upwards, that may not manifest as much of a decline. What we want to see is this momentum really breaking down, breaking this shelf here. That would suggest that we've begun a period of negative momentum that's going to last a year or two. Same thing with the 10, 12-month cycle. It's not enough that we've been in a negative divergence. We've actually been in a negative divergence since 2011, as this momentum indicator has made lower highs persistently for 3 years, but it hasn't signaled a bear market. I believe that it will once it drops into negative territory. It could do that in the next couple of weeks if this decline continues. On the other hand, if we end up closing this week back above 1885, then we haven't broken this trend line. And actually, this week the trend line will be up to 1900. So we need to close above 1900 to keep this intact. If we break that trend line, I think that's a warning signal that we're going to be heading into a bear market. The other issue is this potential broadening top formation. If the market does rebound from here, we'd have a little bit of a broadening top pattern forming. We've had these before. They've broken out on the upside, but it would establish a trading range of, say, from 1880 to about 2020, 2040, that area. So right now we're in the sweet spot. In the 1880 area, 1880 to 1900, if we can extend this decline this week and close below 1880, then I think that would be a fairly strong signal that we've entered a bear market. It wouldn't preclude a short-term rally, even an intermediate-term rally back to 1950 or even 2000 as a top formation continued. Keep in mind that tops usually take a minimum of 9 months and sometimes 14, 15 months to be complete before we get the breakdown and go into the bear market. The bear market itself tends to last only about 30 months from peak to low, with the worst of the declines coming in the last 18 months of that period. So we're going to, I think, see some backing and filling before we get the big decline that I think does lie out there in the next 18 to 24 months. If I had to guess what's going to happen in the short run, I'd say we probably form a low in the vicinity of these channel projections for the 3-year cycle. That's the teal colored dotted line here, and the 18-month cycle, which is the brown dotted line. These lower projections here suggest that there should be some support in the mid-1800s, say from about 1850, or even if it happens this week, the 1875 area. But I don't think we have too much more downside in the short run, no more than maybe 25, 30 points. And then we get a little bottom forming in here and a rebound. The key issues will be what happens when we get back to resistance at the long-term trend line, which in the weeks ahead will be around 1910, 1920. And this trend line that goes back to the 2011 top, that should be very significant resistance as we come back up and attempt to rally, perhaps going into the end of the year. The critical area at that point would be 1930, 40, 50 in there. That should stop any advance, and then the next move should be to a lower low. On the other hand, if this decline stops short right here and we close the week above, say 1900 or so, and we don't get too much lower on any of these oscillators and then they start to recover, all this would have to happen very quickly over a week or 10 days. If that were to happen, then it would not surprise me to see a nominal new high along the top of this potential broadening pattern somewhere around 2050. So if we get a bottom and a sharp rebound in the short run, I'd expect to see 2050. If we go a little lower to the 1850 area first, build a little bottom, and then start to rebound, I would not expect to see a higher high. Probably fall somewhere short of the 1950 area, then roll over and head for a lower low. So that will do it for this week. The big question is whether we get a fast, quick, and sharp recovery that carries a rebound perhaps to minor new highs over the next few weeks, month, two. Or do we go a little lower in the short run and then just get only a weak recovery and then another big decline ahead? And I think we'll probably have an answer within this week or so. So let's get together again and talk about it again next Monday, October 20th. Until then, have a great week, trade sane, and I'll see you next Monday.